Good day, everybody. Today's presentation answers the following questions. What is the gross domestic product? How is GDP related to a nation's total income and spending? What are the components of GDP? This is the first microeconomics chapter. It is worth a moment emphasizing the difference between microeconomics and macroeconomics. Microeconomics is the study of how individual households and firms make decisions, interact with one another in markets. For example, what is the teacher Jack Black's salary per annum? Some of the question microeconomics seeks to answer: how do consumers decide how much of each good to buy? How do firms decide how much output to produce and what price to charge? What determines the price and quantity of individual goods and services? In short, it concerns individual decision-making process. On the other hand, macroeconomics is the study of the economy as a whole, or looking at a bigger picture, or aggregate total. For example, how much does everyone in Australia get paid per year? Some of the questions that microeconomics seeks to answer are: how do consumers decide how to divide the income between spending and saving? What determines the total amount of employment and unemployment? What determines the overall level of prices and the rate of inflation? Because the economy as a whole is just a collection of many households and many firms interacting in many markets, microeconomics and macroeconomics are closely linked. Gross domestic product, or GDP in short, measures the total income of a nation. Just like judging how a person is doing economically by looking at the person's income, the same logic applies while judging a nation. Thus, while judging whether the economy is doing well or poorly, it is natural to look at the total income that everyone in the economy is earning. This is precisely what GDP does. It measures the health of the economy or performance of the economy. GDP measures two things at once: the total income of everyone in the economy and total expenditure on the economy's output of goods and services. For an economy as a whole, income must equal expenditure. This is true that for every transaction has two parties, a buyer and a seller. Because every dollar of expenditure by a buyer is a dollar of income for the seller, income must equal expenditure. This equality of income and expenditure is depicted with the circular flow model. The diagram describes all the transactions between buyers and sellers. Before we go into details of circular flow diagram, we need to familiarize with basic concepts. Factors of production are inputs like labor, land, capital, and natural resources. Factor payments are payments to the factors of production like wages, rent, profit, income, and so on. The simple circular flow has four sectors to which an economy can be divided. Two common actors or players are the firms and the households, and they interact in two markets. One is of goods and services and the other is of factors of production. The diagram describes the transaction between households and firms. The households buy goods and services from firms. These expenditures flow through the market for goods and services. The firms in turn use the money they receive from sales to pay workers' wages, landowners' rent, and firms' owners' profit. This income flows through the markets for the factors of production. In the economy, money continuously flows from household to firms and then back to households. The real economy is more complicated. Households do not spend all their income. Households pay some of their income to the government in taxes, and they save as well as invest some of their income for the future use. Furthermore, households do not buy all the goods and services produced in the economy. Some goods and services are bought by the government. Regardless of whether a household or the government or the firm buys goods or services, the transaction has a buyer and a seller. Thus, for the economy as a whole, expenditure and income are always the same. However, we can calculate GDP of any economy in one of the two ways. Either by adding up all the expenditure by households or by adding up the total income like wages, rent, profit paid by the firms. GDP is the market value of all final goods and services produced within a country in a given period of time. Each word in the definition is very important. Let's consider each phrase in the definition with details. GDP adds together many different kinds of products into a single measure of the value of economic activity. To do this, it uses market prices using the units. For example, Australian dollar in Australia rather than adding apples to oranges. Things that don't have market value are excluded, like doing housework for yourself. GDP includes all items that is produced in the economy and sold legally in the market. The cheesecake confectionery, which makes cakes, uses various ingredients to make variety of cakes. The ingredients used are referred as intermediate goods and the cake is called a final good. GDP includes only the value of final goods. The reason is that the value of intermediate good is already included in the prices of the final goods. This helps in avoiding double counting. GDP includes both tangible goods as well as intangible services. When you buy your favorite shampoo brand, you are buying a good, and the purchase price is part of GDP. When you go to the barber or a hairdresser, you are buying a service, and the price you pay is a part of GDP. GDP includes goods and services currently produced. It does not include transactions involving items produced in the past. Value of used or second-hand goods is not included in GDP. Therefore, new car is included while used car is excluded. GDP measures the value of production within the geographic boundary of a country. Anything produced within the geographic boundary of Australia is part of Australian GDP, irrespective of who or from which nationality produces it. Let's have a look at another measurement called gross national product. It is the market value of all final goods and services produced by permanent residents of a nation within a given period of time. How do the two measurements differ from each other? GDP focuses on where the production occurs, whereas GNP focuses on who produces it. If an Australian worker temporarily works in Japan, their production is part of Japanese GDP and is part of Australian GNP, and vice versa for a Japanese worker producing in Australia. GDP measures the value of production that takes place within a specific interval of time. Usually that interval is a year, or quarterly, that is every 3 months. GDP measures the economy's flow of income and expenditure during that interval. To understand the economy's flow of income and expenditure during interval, we have stock and flow concept. Think of a stock and flow concept as being a bathtub. The current stock of water sitting in the bathtub represents the GDP at a specified time. The flow of water from the tap, that is inflow, or the drain outflow, is the change that occurs in GDP over time. When reports come out that shows the value of the current GDP, the report is talking about the stock of GDP. When reports come out that shows the rate change in GDP, the report is talking about the flow of GDP. When the Australian Bureau of Statistics, or in short ABS, calculates the nation's GDP every 3 months, it uses 3 approaches to calculate the value of national output. The first measure is gross domestic product production approach. It involves taking the market value of all goods and services produced by an industry and deducting the cost of goods and services used by the industry in the productive process, or what is referred as intermediate consumption. This approach uses a concept called value added to calculate GDP. By looking at this example, we see that when a firm produces a good, it must buy inputs. In the process of production, the firm transforms the inputs into something else. The additional value which is added to the value of inputs is referred to as value added. Therefore, the value of the inputs must be subtracted from the value of final product to avoid double counting, because GDP is the value of final goods and services. The second approach uses the expenditure approach to calculate national income. Using expenditure approach, it has four components: the consumption, the investment, the government purchases, and the net export. Therefore, the sum of GDP as referred by Y, which is equal to C plus I plus G plus NX. Let's see each of the components in detail. Consumption expenditure is the spending by households on goods and services, with the exception of purchases of new housing, such as John's spending on coffee at Starbucks. Investment expenditure is the spending on new capital equipment, inventories, and structures, including household purchases of new housing, such as John's purchase of computer for his office. Government expenditures are spending on goods and services either by local or state or federal governments, such as building of public hospitals or purchase of Navy submarines. Net export is the spending on domestically produced goods and services by foreigners minus spending on foreign goods by domestic residents. Therefore, imports are subtracted from exports. The following example shows the working of national income through expenditure approach. Note, the net export in the example is shown as negative per person. This number is negative because imports are greater than exports. The third approach is the income approach, which adds up all the forms of income earned in the economy. Regardless of which measure one uses, it gives the same result, because all the measures tell the same story about economic condition. Few things are excluded from GDP as a measurement, such as intermediate products. They are inputs used to produce final goods and services, and are excluded to avoid double counting. The tires that come with the car are not counted as final goods. However, if you get a flat tire and buy the same tire, it is counted as final good. Second-hand goods are excluded from GDP because the value has already been included in the GDP in the past. Non-market transactions that are produced and consumed at home and which never enters the market are excluded from GDP, such as vegetables grown in your kitchen garden and you enjoy eating them. GDP excludes items produced and sold illicitly, such as illegal drugs. Government spending on transfer of payments such as pensions and unemployment benefits are excluded from GDP because it is not made in exchange for a currently produced goods or services. Thanks for watching. If you have enjoyed watching, please click that like button. It encourages to continue making presentations.